joining in the studios to answer all those questions. Nimish, hi, good morning, and congratulations on the new avatar from SBI. Firstly, how is it that you are explaining the market texture right now to your clients?
So I think the excesses of the 2017-18 are now kind of bearing fruit in terms of the correction which we have seen. The clients are kind of worried about what's happening both on the fixed income and the equity side. Yeah. But I think in terms of the overall valuation chain, the way it is playing out, and also from the point of view of opportunities available even on the fixed income side, this is the time to actually kind of be slightly contrarian and take bets as far as markets are concerned with a longer term perspective. So like what you said, this is the time really to go for tactical kind of allocations to your portfolio rather than getting worried about the short term.
Yeah, and I was just going to come to that because ever since the corporate tax rates have changed, there has been a huge re-rating of that sorts, at least. We know that the HNI fraternity has been sitting with their purse strings tight for the last, say, 6 odd months or 4 odd months. After the corporate taxes announcement, has that view changed? Is that lumpy money now willing to deploy back into the market?
So the sentiments have clearly changed, and the confidence that the government is taking measures over a consistent period of time. Over the last 1 month plus, we have seen the government take consistent steps to boost the confidence in the economy. And the tax cuts are also seen by the clients not as a short-term fix, but more as a long-term perspective from the point of view of bringing a lot of business to India. So our client base definitely is kind of quite happy with what has happened in terms of the actions which have been taken. Allocations have started, and what we are suggesting to our clients is that next 3 to 6 months will give you an ideal opportunity to constantly invest into the markets, and that's where the opportunity should be taken.
So if you had to construct a portfolio for someone who's a bit of a conservative investor for the next 1 year and then again for the next 3 years, what is the ideal asset allocation?
So asset allocation, first we would talk only from the point of view of longer term perspective. Sure. And not 1 year, because 1 year would be more tactical rather than long term perspective. So the asset allocation for a conservative investor is definitely by in terms of what normally is a 50-50 for a conservative investor. But we would definitely recommend that yes, going slightly overboard on equity at this stage over the next 3 to 6 months is something what can really help clients take that better yields. One has to understand that over a period of time the returns in the markets have actually come down. So low interest rates, low inflation, right? So that expectations on the fixed income side have come down. Similarly, if you look at equity, the 18 to 20% return era is no longer true with a foreseeable future. We're looking at 12 to 15% returns. So that compression in yields and therefore the expectations is something which we need to set first with the client. And having said that, this is the time to really look at equities which can give you definitely a better exposure overall and tactically allocate right now.
You seem to be fairly bullish on the mid and the small caps as well. And you like interesting themes, be it aviation or logistics, etc. But one needs to be very, stock specific when it comes to the broader end of the market. I'm not going to ask you names of stocks, but you have that bottom up approach. So what would be the criteria of firms within these areas that you would look at?
So clearly, in terms of the criteria that we look at is in terms of the quality of management, and then secondly is in terms of the valuations at which it is available. So that intersection of growth and value is what one actually goes on to look at, and the sectors which are going to benefit from the tax cuts, the sectors which can actually take advantage of the 17% tax on new ventures. So those are the long-term bets that one would really play as far as these sectors are concerned.
So can you just elaborate on the sectors that you like?
So, without going more into details, but yes, there are sectors where the valuations, especially on the mid and small caps, so we would be more bottom up rather than sector specific, and that's where we would want to kind of focus on. But definitely, sectors like IT and pharma may not see the benefit of tax, but the valuations are attractive. And if you look at banking, definitely they will see a lot of benefit coming out of the tax cuts which are there. So selectively, we will definitely look at sectors which in the next 2 to 3 years will look to grow at least about 15 to 20% on the top line.
But for someone who's not a traditional investor, how much of a percentage allocation within their portfolio would you recommend to equities at this juncture? Because all signals seem to be telling you should be increasing your exposure at this juncture. Right now is the time to buy.
So I think it's a graded approach over the next 3 to 6 months because we still feel that the worst may not be over in terms of the recovery of earnings. Okay. So we will see a few more months or quarters where you will see subdued earnings coming through, and that's where we are saying a graded approach over the next 3 to 6 months to the allocation to equity should be done rather than putting lump sum right now.
Okay, fair enough. What about the outlook on some of the other asset classes as well? The likes of gold, even real estate. Are you recommending exposure there, and how much?
So gold, given the global uncertainties and slowdown which is happening, and also from the point of view of the way the interest rates are moving globally and especially in the US, definitely it's an asset class which has to be kind of having some allocation. So normally we recommend about 5 to 10% allocation to gold. While the talks have been that yes, beyond $1,400 an ounce, there is a upside in gold, but we are not looking at the kind of medium term, but with a longer term perspective that will definitely help. Real estate is a very tricky answer because we don't have any good quality real estate funds available right now. And also from the point of view of it's a very micro market, so we would not recommend on real estate. But yes, fixed income is one other area where there is a lot of opportunity available to take good returns at this point of time.
Okay. And in terms of the overall market at the current juncture, just to drive home the fact, are you convinced now that with things having changed on the corporate tax front, that overall sentiment is on the upside? For now, there will be bouts of consolidation, but by and large, things look good?
So I think I would like to take this question more from the point of view of the intent of the government with the long-term perspective. So most of the measures that the government has taken are not short-term in nature, and they are more long-term perspective. Okay. So from there, one can definitely say that the sentiment, while is euphoric initially, but as the economy stabilizes, as we see the effects of these actions coming in over the next few months and probably a year or so, that's when the real kind of confidence will again come into the markets. But till then, that will be an opportunistic way to really kind of start tactically allocating to, for example, a lot of clients would have reduced or automatically the mid cap and small cap exposure would have gone down over a period of last 1 year. This is the time to actually kind of bring it up to the normal asset allocation, which was not recommended earlier as such.
Sure. Nimish, great having you in the studio. Thank you so much for taking the time and speaking with us. Pleasure.